ADI has been doing a lot of work in the downstream part of the value chain. So we'll start with some of the key insights from ADI's work. But firstly, I'd like to thank our panelists, Mike Reed and Chris Efird. Thank you so much for joining us and agreeing to share your thoughts with us today. So talking about the 6 or the 5 key insights based on ADI's research in the downstream. So what we have seen is that the total US refining capacity is growing much slower, but we see that the largest refineries, including the Port Arthur and the Marathon, are growing much faster as compared to the overall refinery capacity. Now, if we look at some of the reasons of the slowdown, one of the main reasons is that the plant maintenance was delayed heavily due to COVID, and now we see that they're picking back up. So as you see in 2023-2024, it was still slower, but now as we see through 2028, we see that they are picking back up. So, and the other thing to note here is that the turnarounds are also going to are going to pick back up after 2025. Another factor of slowing refinery capacity is more and more contribution from biofuel refineries. And we see that several of them are actually undergoing conversions to produce more and more of bio-based fuels. So some of the examples that we see here, one of the key one is closing of Phillips 66 Santa Maria refinery in January of 2023, followed by the Phillips 66 Rodeo refinery, which is expected to start producing biofuels sometime early this year. Also, Marathon is in the process of converting its Martinez refinery into a renewable fuel facility. And we see that Global Clean Energy is also converting an old refinery. So this is one of the other key reasons why we see refinery construction, refinery capacity slowing down. However, if we look at US exports of refined products, they have still grown. The growth is mainly coming from the US Gulf Coast, which is a part of PAD 3. And we expect this to continue. And we also have a multi-client where we talk about continued exports from the US to Latin America. So that is one of the drivers of US exports of refined products. So these are all the insights we had for today. Moving on to the discussion with our panelists. So, one of the key questions that we have is, what market segments do you see your companies serving? And, are there any existing refineries that you see yourself competing with versus partnering with? So we'll start with you.
So it's interesting. It's fuels and refining. We're a biodiesel producer. We're located in Port Arthur, in the Port Neches, Port Arthur area. The plant's been producing biodiesel there for over 15 years. It's one of the largest of its kind that's not integrated into a crush plant, which typically you see at an ADM or a Bunge. Private equity backed by a company called Metalmark, former Morgan Stanley guys. We make about 7,000 to 8,000 barrels a day of biodiesel. I kind of call it the Gen 1, renewables versus RD or even SAF. So we've got a good market in the sense that Texas has a excise tax credit for biodiesel blended. So we see a lot of our customers, which are all the obligated parties, the majors or the big box retail guys, blend up to a B20 seasonally. In the winter they'll dial it down a little bit. But for us, our margins are obviously being affected now based on RVO and the RFS changes that just came out, and the basically the threat from RD. But for us, we're still making biodiesel. We do have some projects though to diversify and grow the business, particularly SAF.
That's helpful.
Perfect. So we are active, Houston-based company, but our projects are in the state of Oregon. We're focused on the West Coast, LCFS, CFP marketplace for the second generation fuels, the RD, the SAF. We have two projects, one greenfield in Northern Oregon, large scale project on the same scale of Phillips 66 project at Rodeo, and then we have a second asset, brownfield asset, that we're in the process of converting right now, smaller. The big asset, 50,000 barrels a day, 700 million gallons a year. Investors include some major airlines, United being one, some large energy companies. Smaller project, much more regionally focused, 3,500 to 5,000 barrels a day. So that kind of core business is the fats, oils, and greases converted into the renewable diesel and sustainable aviation fuel. Smaller unit is RD only. Bigger plant is intended to be 50-50 RD SAF. However, at our Southern Oregon asset, for those of you who know anything about the industry, one of the names that's been around forever was Renewable Biofuels. They went out of business. We acquired their asset last year, and we're currently redeveloping it, part of it into a HEFA facility for renewable diesel. The other piece that they were going to make sustainable aviation fuel out of woody biomass / waste wood, we're actually converting into a synthetic green hydrogen, RNG, generation unit. We're very close to the Tallgrass Ruby pipeline, so we have a direct pipeline RNG offtake that we're going to be working on. So we have our toe in several of the segments that are active out there right now.
Yeah, that's helpful. Thank you. So biofuels is not quite new in the market, and we see that there's a broader fuel and refining mix, but it is still benefiting from rapid expansion. So could you talk a little bit about how you see biofuels today and where you see it headed? Because you mentioned that you are facing some competition from Gen 2.
I think when I kind of take a macro view of the market, clearly, the low carbon, at one point it was energy independence and maybe even a shovel-ready ag subsidy back, in 05, 07, or maybe even, the energy independence. It was George W. who actually came up, put the RFS in place. I think, the continuation of low carbon, Biden's recent, support of SAF obviously is pushing that. I don't know. It'll be interesting when the next RFS is set, which we should hear something sometime later this year, early next, from 26 on, how much they really move the mandate. This time last year, obligated parties were paying close to 20 cents a gallon of regulatory costs. Now it's less than 7, with RINs moving down as low as they have. So it'll be interesting to see how much, because it's a mandated fuel and it's regulated, it'll be interesting to see how much headroom we get in the RFS next year. I think a lot of the credits have shifted to SAF, whether it's the LCFS credits or just the credits in the IRA have really pushed SAF. So it'll be interesting to see if they stay in the D4 RIN category, whether they get their own. Jet fuel is not an obligated fuel, so I think the EPA has to take a look at biodiesel, RD, SAF, and kind of figure out what the right mix is. The one last comment I would say is, if you look at the amount of used cooking oil that's actually now coming into the United States, I think the EPA completely miscalculated how much of that would be incented to come to the United States, and it could continue to price in, and it'll be an interesting. One of their RVO calculations is how much feedstock is out there, and is it food for fuel discussions. And now with the amount of UCO that's actually coming in, it'll be interesting to see what they do with the RVOs moving forward, which will drive investments and demand for renewables.
Yeah, I couldn't agree more. I mean, the industry is a bit of an inflection point right now. You've got a whole bunch of things that are happening. You've got needed change being pushed in the RFS. I mean, the EPA just completely missed the RVO. You know, they targeted one level, and the RIN credits have just blown, at least the D4s and D5s have just blown right past the target. So you've got an oversupplied RIN market right now. You've got tremendous pressure on, you know, particularly the D4 RIN, which the biomass-based diesel relies on. At the same time, you've got in California the low carbon fuel standard. They totally missed what renewable natural gas was going to do to the LCFS. When you've got dairy gas coming into the market that's getting scored under the LCFS, under the GREET model, at a negative 300 CI, where your fuels are 30, 40, 50 CI, well, what does that mean? It means that the dairy gas is basically sucking up the entire LCFS. Your prices are falling. So right now, you've got, at least in the RD space, I can't speak to the biodiesel space, but in the RD space, you've got a crack spread that's lower than it's ever been seen before. And frankly, is pushing a number of projects, even plant conversion projects, to the point of economic non-viability. Now, what's going to happen there? There's going to be some shakeouts. There are some big regulatory changes coming next year. The new 45Z credit under the IRA will replace the historic BTC blender's credit, $1 per gallon of biomass-based diesel, and it'll carbon index it. So that if you're not doing at least a 50% reduction under carbon intensity, you don't get any credit whatsoever. It's going to be interesting to see what happens in that dynamic. Diesel fuel, 102 grams of carbon per megajoule of energy. It's got to come down to 51 before you get anything. And so, you know, you look at some of the producers, it's going to be an interesting shakeout. And then you add to that, as it showed on the screen a few moments ago, Phillips 66 Rodeo comes online. That's 60,000 barrels a day, 800 million gallons a year. When Nestle Marathon at Martinez comes online, that's about 600 million gallons a year. That's going to be coming into the market. It's going to displace some fuels. It's going to continue to increase the decarbonization, but it's going to push a whole lot of RINs into the market. So 24 is going to be an interesting year to see how all of this balances. You know, I think the states are going to react, particularly the West Coast states. Washington now has its own LCFS, Oregon CFP. The states want to see this decarbonization. As a matter of fact, every time the numbers go up, they move the goalpost to have greater decarbonization. And so what are they going to do at the state level to help incent this production?
And you had New Mexico just ratify an LCFS-based fuels program, still to be determined, but I think that's a trend that at the state level you'll continue to see, kind of the California type or West Coast model, because now Oregon, Canada, Oregon, Washington is starting to move further east, and you've heard, you know, the
New York,
the blue states, the New Jerseys, the New York, you know, pushing towards it. So between the state and the feds, it'll be interesting to see where the incentives for investment, you know, kind of really shake out.
Yeah.
So you mentioned used cooking oil is being imported. How do you see the feedstock landscape evolving for biodiesel and renewable diesel or SAF?
You want to take it, Bert?
Yeah, you know, look, I'm a native Houstonian. I grew up in the downstream side of the traditional oil and gas industry, and the old adage around town is the cure for high prices is high prices. The cure for low prices is low prices. What's going to happen is more feedstock is going to come into the market. We're already seeing it with the UCO, used cooking oil. You know, huge amounts of Chinese used cooking oil are now starting to move into the United States. Why? Because there's demand for it. Now, there's all sorts of issues. The EPA is getting into that, and they're asking questions about traceability. Where did this stuff really come from? You know, is it palm oil, which is a bad four-letter word in the industry? And so there's a lot of catching up that has to do. But I think a lot's been said about, there's going to be a lack of feedstock. Ultimately, sure, there will be. But you're going to start to see new things. You're starting to see innovations in things like cover crops, where in the Midwest, when you harvest the wheat or you harvest the soy, you put down an oil-rich cover crop. BP is invested in that. Exxon is made a big move into that. You're starting to see some initial moves in algae oils. So I think new feedstocks will emerge. There will be timing disconnects, of course, and so you'll see prices jump all over the place. Right now, West Coast UCO is significantly cheaper than soy, and that's because of the huge flux that's come into the country. So it's there. It's going to be interesting to see renewable diesel, at least using the fats, oils, and greases, the HEFA process, and biodiesel use a lot of the same feedstocks. And so it's going to be interesting to see how that dynamic plays out over time. So again, 24 is going to be an interesting year. I think there will be sufficient feedstock for planned production that's out there now. Now, clearly, if the entire country decides to go to an LCFS standard, which I don't see happening, but if it did, then yeah, we'd have a feedstock problem.
But so when it comes to availing the maximum advantage of IRA, doesn't it have to be sourced locally or domestically in the US, or can it be
just CI based? Well, it will be starting in 25 with the
Right.
PTC. It's just CI based, so it ranges anywhere from over $1 in some cases with some feedstocks to the low end, maybe of 36 cents per pound for soy. So it doesn't have to be U.S. It could be anywhere as long as the CI.
Now, where local content does matter is in construction in your plant. So there's significant local content rules, and then in addition, there's all sorts of labor rules and environmental justice rules and rules that, quite frankly, drive up the cost of construction significantly. But the feedstock you can pull from anywhere.
Okay, that's helpful.
I think just one more comment on what he was talking about on feedstock. I think what we've seen is where UCO, because that's really been probably the biggest change, at least in my opinion, that we've seen in the last at least 2 years, and really since the RVO was set in June of last year, is we actually now know basically what price UCO needs to be at to come into the United States, where it was a cost for a city, a restaurant, a human being to once get rid of it. Now there's value in it to aggregate it and ship it. Yes, there are probably a lot of cases where it's being sprinkled with some other stuff, that happens whenever money's involved. But I think that's an interesting. Get back to the original question: will we ever run out of feedstock? It depends on what you want to pay for it. It's like, will we ever run out of diesel? No, not if you're willing to pay $10 a gallon. We won't run out, but you may not like the price. So I think feedstock, and I think the RVO that's going to get reset, if you really back up and look at it, you're actually now seeing what the plan was originally designed, which was go out and find new technology on algae and oils and switchgrass for cellulosic, or go and recycle a bunch of UCO. Well, now we found the price that actually it arbs into the United States, and I think that's a significant change in where we are with biofuels moving forward. I think.
I agree.
Which could be good for all of us, if all of us meaning the producers here, but the consumer, you may disagree, but I think it could be if the RVO is increased, it could be an uplift for renewable fuels.
Right.
So if we talk about competitiveness, we see that SAF right now, it's almost 3 times the jet fuel price, and which makes it a little competitive, but it's still very expensive to produce. So in a case where it's not covered with all these credits and not pushed so hard, how do you see that going forward, the competitiveness?
I'll say history repeats itself. As I said earlier, our plant's 07, 08 vintage, so the Energy Independence Act was 2005-06, and it took $1 a gallon. Soybean oil was selling for 7 cents a pound. On the screen now, it's 42 cents, and it almost went to $1 after Putin invaded Ukraine. So it's the investments that the government makes to make these projects work, and so SAF needs these credits to develop that. No different than hydrogen and any other transition fuels. It needs it to get established, and then at some point it could get saturated like RD and other things where the market will actually balance itself, whether it's on feedstock or final product.
So SAF today is benefiting from the great hype machine. Hey, we have to decarbonize aviation. We're not going to be flying airplanes across the Pacific Ocean on batteries. So how do you do that? Okay, so sustainable aviation fuel, biokerosene effectively is the way to go. There's all sorts of challenges in there, and we have public information, strategic partnership investment from United Airlines. We're working with some other airlines. They have no clue how to buy SAF. I'll just sit here and say it right now. These are consumer-facing businesses that operate on very, very small margins. They're never going to pay $7 a gallon for kerosene, for Jet A. So how do you make it work when you've got your feedstock costs, which are significantly higher than a gallon of traditional petroleum Jet A? How do you make that work? How do you clear it? Well, you've got the credits that get stacked on top of it, but a lot of these credits, they track the same general market, the same LCFS, et cetera. There is no, they are not obligated parties, as Mike said earlier. We don't have mandates like they do in Europe and they now do in Japan. So how do you make it work? I don't know the answer to that. The industry's trying to figure that out. They have this enormous amount of SAF that they want to bring in, and you've got a very small amount of it being made. The other challenge that you've got is if you're a renewable diesel producer, so you're using fats, oils, and greases, or one of the more exotic technologies, but let's focus on the volume, the fats, oils, and greases. You do much better making RD than you do making the kerosene. You've got to take it through another fractionation step. You take a yield hit on that. And so if you're an airline saying, hey, I want you to make SAF, an RD producer is going to say, well, you got to pay an RD plus a premium just to get into a conversation. Never mind where it ultimately ends up. I think the answer ultimately is going to be some of the end users, and yes, it's airlines, but it's not really even the airlines, it's the airlines' major customers, where we're starting to see some back-to-back arrangements from some of the big carriers, particularly in Europe, back-to-backing with a corporate that is very interested in their scope 1, 2, 3 emissions and all the rest of it, where in that actual ticket, they will pay a premium, because the airline's not going to pay a premium if they're not able to hand it off to somebody. That plus we're starting to see book and claim, just like you have in the RNG space. We're starting to see the emergence of a dynamic where those environmental attributes can be detached from the actual SAF molecule. So the molecule can go to the airport, it can get put into a plane, but a Microsoft, which has done a deal in this space, the Amazons, the others, can actually monetize those credits independently, and that becomes another pool of financing that you can go after. It's a bit of a befuddlement, to be quite honest, because there's a lot of people asking for, where do we get the SAF? Where do we get the SAF? It's like, well, SAF can be made if you're willing to pay for it, but not at the opportunity cost of selling a gallon or a barrel of renewable diesel, because that has a very mature distribution chain, a very mature credit trading regimen. These airlines have never traded these environmental attributes before. There's a lot of learning that has to go on before you're going to see that market develop.
So the quick answer is it's policy driven. I mean, we're here because it's policy driven. You got those investments weren't made in biodiesel back then, and they won't be made, or they'll be delayed in SAF if there's not a clear path, because the money just won't support it. The smart money will not back it. Yep. So it's got to be policy driven. It has to be sustained, which is which is interesting in our space because it has gone, on a roller coaster. Through the administrative, every 2 and 4 years, something changes, for sure.
And just one other comment on that, because that's absolutely spot on. When you go into the project finance space, the big project finance banks will pretty much write your credits to zero because they view them, the credit portions of your revenue stack, because they view them as binary political risk. They don't know 3 years from now, 5 years from now, what is that RIN going to be? Is there going to be a 45Z credit? What's going to be out here? And so you're having to make an argument, using statistical models saying, hey, if we back test this, they never went to zero, they never went below that, et cetera. Trouble is we're testing the low bounds with the credit values right now. So it's a tough space. We don't have mandates in the United States. So you can't say, oh, well, you got to do it like you have in Europe. It has to be incentive based, and the RVO is a place where I think EPA is going to make some adjustments this year because they realize they overshot it. California is adjusting the LCFS now. So, but again, the timelines don't always add up.
So this may be a little tangential question, Chris, but you mentioned Red Rock's biofuels, and it was supposed to be, so I assume it was supposed to be a gasification-based SAF facility.
Yeah.
So my question is that what are the factors that go wrong when, say, a facility is not successful? Because if we look at the demand and if we look at the reception that the SAF is getting right now, any facility should be successful. So why would a facility not be?
It's hard to make generalizations off of what happened to Red Rock. I mean, I won't go into all of the details, but because I don't know all the details. I know some of the details, but they got hit by COVID. They got hit by issues with the EPC. They had a very long gestation period, and their bondholders literally just kind of had it. They chose some very early technology. So their process was, wood waste, pyrolyzed. So they had a pyrolytic unit from a manufacturer that had never made one before. It may work, may not. They never got to that point because, frankly, they ran out of money before they could get the whole kit put together. And so the challenge, and the reason we're not focusing on that piece for the SAF is it's just pure yield. I know there's a lot of very smart people working on some really cool technologies to convert all sorts of stuff. Fischer-Tropsch gas to liquids has been tried for a long time. It's a yield difference. On fats, oils, and greases, you get about a 90% yield. Weight of feedstock to weight of sellable product. In a wood biomass, I can't speak to municipal solid waste and the rest of it, but in wood biomass, you get about an 18% yield. And so, the argument is always, yeah, but the wood's free. No, it's not. It's got to get collected, it's got to get transported, it's got to get handled and touched. And so by the time you do that, you're doing a whole lot of effort for very little output at the end of the day. And so then you go and you talk to your airline and say, I don't want you paying $7 a gallon, I want you paying $27 a gallon so that we can make our math work. And they're like, yeah, no thanks.
Okay, that's it. Okay, so can you talk a little bit about biodiesel supply outlook? How is the competitiveness today? And what do you think needs to happen to make it competitive in the future?
Right now, today, RIN's traded at 42 cents. I don't know if you saw it. Today, traded at 42 cents. A month ago, 4 weeks ago, it was 85. So you've seen it drop. And, some would say, well, it's going to zero. Probably won't go to zero, but it could get close. So biodiesel kind of lives in two camps. If you're a large integrated guy, or you have the cash or the balance sheet to put on hedges and protect yourself far enough out, you can still run probably at close to break even or slightly positive margins. If you're not, and you're not as sophisticated, or you're kind of hand to mouth on your feedstock and your sell, which can be advantaged in some cases, then you may be struggling. Like I said, there is a blend market in Texas that's robust, and there's a lot of infrastructure designed around it. But I think, competing with RD, it's very difficult because you don't get the additional tax or incentives, LCFS credits, et cetera, or some of the other LCF program credits, or where you don't have to pay a certain fee because you're not making that fuel. But I think biodiesel is definitely going to be challenged unless there's some policy that shifts to change, to have all three, SAF, RD, and biodiesel work.
And how do you see new capacity? Is there new capacity being planned for
biodiesel? No, I would say it's going to go the opposite direction. European has their own capacity. There's trade barriers between the two. Argentina, Brazil, they have, they're big ag countries. They have their own production, and there's definitely trade barriers that the farm lobby in the United States did a good job of keeping some of that out. Then you got the whole Palm, Pacific Rim, India. They've got their own production. Indonesia has a 30% mandate. So I don't see any more biodiesel. If anything, I see some either seeing if there's a policy change and maybe going down, or making some repurpose or reposition, which is what we're looking to do. Because of our position on the Gulf Coast, we've got deep water. We're in the energy corridor, so we think it makes sense for us to go to SAF.
So repurpose, you mean repurposing the facility?
Deep water meaning we've got a global position. We can take advantage of any ARBs that open up on a global. If you're in Iowa or Dallas, your transportation logistics are.
So you mean access to
the
foreign
global markets? Yeah, the global market. Whether it's selling SAF into Europe or SAF to other places, long term, there's value. We think at that asset.
That's helpful. How about a similar question, but for renewable diesel and SAF? How do you see the competitiveness today and going forward? Again,
you look at the history of the energy industry. If there's one thing we know how to do in this town, it's to overbuild things, and then we let the market catch up. I think that's going on in RD right now. Now, a little bit difference, and I touched on this earlier. We have seen this multiple times just in the last 13 years that I've been working on these projects. The western states are very aggressive. They would like to go to zero carbon, and there's a lot of electrification movement, of course, but there's also recognition that the high horsepower heavy transport is not going to electrify. The airplanes are not going to electrify, so you're going to need energy dense liquid fuels. But there is a lot of capacity that is coming online on the RD side. I do think there is a significant hesitancy for people, other than some of these more technology-ish plays, to jump feet first into SAF, just until the whole pricing model can get sorted out. There's a definite desire. In Europe, Japan, there's a need to meet a mandate, but it needs to get sorted out. So yeah, I think construction is going to continue. I do think that you're going to see, share of the biomass-based diesel market drift away from biodiesel more into the RD, just because it's a drop-in replacement. You can use it at 100%. I think, the facilities that are coming online now, the facilities that are, announced through permitting, under construction, will get built, and I think they'll find a market. Similarly, our project in Northern Oregon is on deep water, and the whole reason for that is the ability, same thing you said earlier, on the Gulf Coast. We want to be able to bring in the volumes of feedstock and then send the product out to wherever the best market is, be it the U.S. or others. We have several Asian airlines actually that we're working with that are looking for volumes here, and then also volumes going back to their home countries.
So in our research, we've come across, so HEFA, for instance, that there's a certain portion of renewable diesel yield, and then there is a certain portion of what you can sell as SAF, and then this other lighter ends like renewable naphtha. So when you say that, okay, there's a facility that's going to be focused on renewable diesel, what happens to those other ends? Or are you still monetizing them but not as SAF?
So in our specific case at our Port Westward, which is the Northern Oregon facility, we're using the UOP eco-fining technology. It's dial a yield, so we can go anywhere from 100% RD to 50/50 SAF, depending on market conditions. And the shift is not a major event. We do make the naphtha, we do make the LPG, but in our specific case, we're in Western Oregon, an hour and a half west of Portland. It's very rural, very nice dock. We have 645 acres there. We utilize a hydro-treating process, meaning we need a lot of hydrogen. You ain't got no hydrogen in Western Oregon. And so we do have natural gas. We will be reforming natural gas initially through an ATR, and we're going to be doing some carbon capture. But once we're up and running, we're actually recycling the off gases, the naphtha and the LPG, back into the hydrogen plant. So we're not selling them. We're using them to displace a significant portion of the NG that's coming in, and it's for carbon intensity reasons.
Same with us. It's a value calculation but in the Gulf Coast, you can take those and sell them as cracker feed and get some green credits, plastic green bottles, or the propane could go to polypropylene, whatever propylene. So propylene glycol. There's a few other goodies that you could get from that.
Okay, that's helpful. If we talk about all these big refineries converting their facilities to make biodiesel or renewable diesel, how do you see as an independent biofuel producer competing with these refineries?
So I'm going to answer your question, but before I do, I want to make one comment on that. I don't know how ubiquitous those conversions are actually going to be. A lot of the conversions, with the exception of what Valero has done in Louisiana, now Port Arthur, where they're basically bolting on units, taking advantage of some of their balance of plant. The conversions that you've seen on the West Coast were facilities, I don't violate any confidences here, but facilities that probably didn't have a long life going forward anyway, due to local regulations or age of equipment or whatever. And so it was a very logical calculation to say, hey, you know what? Let's just go ahead and convert and get into this marketplace. I don't think that's a generalizable case. You look at the gymnastics that BP is going through on Cherry Point right now. They came out and said, hey, we're going to do a bunch of conversions, and then they didn't say much else. So that's a very profitable refinery. Don't have any inside information, but I'd be shocked if they were to convert that refinery. All of the hydrocarbons that go to Seattle, Portland, and Point South come down the Olympic pipeline, and they all come from basically that area. So listen, competing against that, it's hard. They have balance of plant. They're big companies. The biggest issue is not the barrels that are coming into the marketplace. The biggest challenge that companies like mine have, which are independent developers, is they're doing everything on balance sheet. They don't have to go out to the project finance community and sell the future or sell the forward curve of the RIN, and get them to buy off on it. They just make a corporate decision and say, let's do it. That's why I don't think, you're going to see refineries nationwide suddenly decide to do RD conversions. It doesn't make economic sense for them. It absolutely does for some refineries on the West Coast, but I don't think you're going to see enough of those refineries convert, given the need for the petroleum products, to meet the demand that the states are asking for. So I do think there's room for some niche players sitting out there. It's not completely open-ended, certainly. It's something we focus on a lot. It's one of the reasons, to be completely honest, we chose Oregon. Permitting our big project was what I would consider a full contact sport. That's a hard place to get things done, but by the same token, they now have their refinery, and it's a renewable refinery, when we get it built, clearly, but it's moving along the way. I think that's going to be a very nice market for us, and I don't think others will come into the market. Others are in the market now, but I think there are niches that you can play in.
So,
I would just add, I think, to the point that Chris said, I think, when you look at it, how they financed or how they converted, balance sheet, obviously flush with cash over the last 2 years of cracks. And then their ability to compete in the market they're in, their fuel constraint right there, they can outbid most anybody else for, the feedstock. So I think, they're definitely, and they're in the same category as me for biodiesel RINs. So, it's a formidable competition. Even though I don't send any of my product to California, it's still the winds are strong blowing this way from there.
That's helpful. So if we talk about willingness to pay a premium, like it's pretty high for SAF right now, but how do you see this evolving?
I don't see, based on multiple conversations with potential counterparties, a big premium being paid. The highest premium I've seen out there is there's one producer of small but decent volumes that's getting basically RD plus 50 cents. That's the biggest premium I've seen. That math works, but it's for a small offtake. I don't think it's necessarily generalizable. The airline that's doing it is doing it kind of as a test, so I'm not sure how long it goes, but that's good. I've seen a couple of RD plus 10 cents. That math in this credit environment doesn't work. But I don't see a big premium there by the airlines themselves. Again, they operate on thin margins. I think you've got to go to those groups that are concerned about the emissions. You've got to go to the Amazons, the Nikes, the Microsofts, generalize it out to a lot of different companies. And we're seeing movement in that space. There are groups that are coming to the airlines and are saying, hey, we would like to do a volume purchase program. That stuff is still just very young, but that's the only way that I think you get the kind of premiums that would make the math work. Or what you do is, and we've explored this as well, you actually strike offtakes with some of those airlines where they actually share in the credit stack, much like the super majors do when they do offtakes in this space, where you're saying you're getting some type of guaranteed purchase, guaranteed margin, guaranteed something in exchange for a significant portion of the RIN, the LCFS, and 45Z if it becomes available. That way you get them in on the risk curve. We're seeing some conversations with very large retail, big box retailers as well on the diesel side, not on the jet fuel side. So there's going to be some interesting models emerge in here. If you want to increase the volume, particularly relating to SAF, there's going to have to be.
That was very insightful. I'll open it up. I think we are almost on time. I'll open it up for any questions.
Thank you. My question is directed to Chris. As you said, renewable diesel requires a lot of hydrogen, especially when you build a plant size like 50,000 barrels per day. And this is an opportunity for the deployment of, electrolyzers. And many companies are still looking to develop their niche market. But as you just mentioned that you would be leveraging the ATR or SMR, and that has its own challenges. I just wanted to understand from you is, because you want to hit the low CI score for your products like renewable diesel or the SAF. Is it the cost concerns or the logistic concerns to deploy those electrolyzers versus ATR, SMR, and carbon sequestration?
Right. So, doing business in the state of Oregon, this is a conversation I've had probably about 1,000 times. Very, very big, actually been legislated by the Oregon legislature, focus on hydrogen definition, green hydrogen usage, et cetera. So, big deal up there. The challenge you have is just the scale. I mean, we're going to utilize 350 plus tons of hydrogen a day. That's a lot of hydrogen. At Port Westward, River Mile 53 on the Columbia, there are 3 power plants. Portland General Electric has 3 power plants. They're all natural gas fired, 1.2 gigawatts of power. We did the calculation. To be able to get enough electrolytic hydrogen for our plant, we would take everything off of those power plants. If they were running on RNG or something else, it's brown gas, so that doesn't work. So, I think ultimately that's where the industry is going to go, because it's going to be, as all of these plants start to come online, how do you differentiate yourself? It's CI. If you're able to get a really low CI, and then you've got logistics and everything else you have to worry about. And so we are looking at some interesting technologies, not so much for Port Westward because of the scale, but down south we're looking at, there's a very interesting company that's doing methane pyrolysis, where you're getting clean hydrogen, you're getting, graphene effectively coming out the bottom, and it scores negative CI. So there are some of those things that can be utilized. Again, being from Houston, my wife actually drills natural gas wells, so I'm a big proponent of natural gas. I think it's going to be a key component in a lot of this hydrogen that's going to be needed in the energy transition. You just got to figure out what you do with carbon. You either grab it and bury it, or you do, some other technology that allows you to not vent, the CO2. So we're using the recycle for CI. Also the fact that with where we are, there's a bit of a green LPG market. The only thing we can do with the naphtha is bring it down here, and the net back doesn't make any sense. So that was an easy one.
Just a clarification question. So do you think with the ATR and SMR with CO2 sequestration, we can hit the 50% threshold of reduction in carbon intensity with the benchmark SAF?
Yes.
Okay.
Yeah, we've had it modeled, and we're significantly below that. Again, it's a bit feedstock dependent, of course. If you're running all soy and you're starting at a 65 CI, it becomes a bit of a challenge. But if you're blending, some UCO, some tallows, and things like that, yeah, you can get down sub 30.
Thank you guys for the panel, really insightful conversation. I have a question. A lot was said about policy support, especially around SAF. What is you guys' opinion when this policy support is no longer in place, especially in the US? What's going to happen with SAF supply?
If you've got an average feedstock price per gallon of I'm going to discount the really low price of UCO right now. If you just look at kind of the averages, you're $4.25, $4.30 ish, maybe down closer to $4 in some cases. If a gallon of Jet A is going for whatever it is, I haven't looked recently, but $2.50, $2.60, that math doesn't work. So if you don't have any credit support sitting in there, the industry doesn't function. So in the United States, I think it's safe to say we're never going to have a carbon tax. And without a carbon tax, the only way, or mandates, the only way that you get there is with these incentives. And so, you kind of pull them apart. You look at the RFS, where the RINs come from, at the end of the day, that's really, they sell it as support for biofuels, but the reality is it's support for farmers in the Midwest. And so I think politically, that's probably not going anywhere. RVO levels will vary. Small refinery exemptions will go up or down depending on the administration, but I don't necessarily see the program going away. So I think the political risk there is limited. Similarly, on the western states, they're moving as fast as they can to decarbonize. They want to put up, increase their percentage of biofuels. They're lower their aggregate carbon intensity across their motor fuel pool. California had an LCFS standard. Oregon jumped on top of them. Now California has a new set of proposals where they're going to go ahead and leapfrog over Oregon again. I mean, it's a game out there. I think those programs are going to continue to exist. They're disconnected from the federal programs. I'm not so concerned with the programs going away. And I've said this a couple of times, what I'm concerned with is the fact that the timelines don't line up. You'll have a market reaction, and then the regulators will say, oh, crud, we're screwed up. We need to make an adjustment. And in that, 18 months it takes for that regulatory response to occur, you can have some pretty big carnage in the industry. And so that's really the bigger concern that I have in terms of that. The IRA, who knows what happens with the IRA? It's going to take Congress to undo the IRA, but a new administration with different objectives could change enforcement. They could change, the IRS came out with the guidelines. They could change those guidelines. Mm-hmm. There's all sorts of risk there.
And these investments are, billion plus. They're not 20, 30 million, right? They're, from a timing perspective, that doesn't happen in 18 months, 24 months. You got to have, it's got to be bankable. I mean, at the end of the day, it's got to be bankable, and there's, the policies shifting and moving as it has, definitely make it a challenge.
Okay. Thank you so much. Thank you for the questions, and thank you for the amazing panel.
Appreciate it.
Start wrapping up day one.